This chart explains how the RSI, or Relative Strength Index, helps identify potential turning points in a stock's price. The top section shows the stock's price movement, rising and falling over time. Below it, the RSI indicator moves on a scale from 0 to 100. When the RSI goes above 70, it enters the overbought zone, meaning the price may be too high and could start falling. When the RSI drops below 30, it enters the oversold zone, meaning the price may be too low and could rise again. By comparing the price chart with the RSI indicator, traders can get an idea of when a trend might reverse. Overall, the RSI helps measure how quickly prices are changing and provides hints about possible future price movements.
This chart explains how the RSI value is calculated step by step. First, you look at the daily price changes and separate them into gains and losses. Gains are positive numbers when the price goes up, and losses are negative numbers when the price goes down. In the example, the gains are +2, +3, and +1. The losses are -1 and -2. Next, you calculate the average gain and the average loss. The total gains add up to 6, and when divided by 3 days, the average gain becomes 2. The total losses add up to 3, and divided by 2 days, the average loss becomes 1.5. After that, you compute the relative strength, also called RS, by dividing the average gain by the average loss. In this example, 2 divided by 1.5 equals 1.33. Finally, you plug the RS value into the RSI formula. RSI equals 100 minus 100 divided by 1 plus RS. When you perform the calculation with the RS value of 1.33, the final RSI becomes 57.1. This number helps indicate the momentum of the price, where values above 70 suggest overbought conditions and values below 30 suggest oversold conditions.
This chart shows how different RSI settings react to price movement. At the top, you see the regular price action displayed with candlesticks. Below it, a chart compares 3 RSI lines based on different time periods, 7, 14, and 21. The red line represents the fast 7-period RSI. It moves quickly and reacts sharply to even small price changes, which means it has high sensitivity. The blue line is the standard 14-period RSI, which offers a balanced response and is the most commonly used setting. The green line is the 21-period RSI. It reacts more slowly and smoothly because it averages more data, giving it lower sensitivity. All 3 lines move between the overbought level near 70 and the oversold level near 30. But the speed and smoothness of their movements differ. In summary, shorter RSI periods give quicker signals, but can be noisy, while longer periods provide smoother signals but respond more slowly to market shifts. This chart explains how the RSI helps identify overbought and oversold conditions in the market. The shaded red area at the top represents the overbought zone, which occurs when the RSI rises above 70. When the RSI enters this level, it signals that the price may be too high, and traders should prepare for a possible drop or correction. This region is considered a risky zone because the asset might be overvalued. At the bottom of the chart, the green shaded area represents the oversold zone, where the RSI falls below 30. When this happens, it suggests that the price may be too low and the asset could be undervalued. This area is known as a possible reversal zone, meaning the price might rise soon. The black line moving through the chart is the RSI itself, going up and down as market momentum changes. Overall, the chart shows that RSI levels above 70 warn of potential downward movement, while levels below 30 point to possible upward reversals. This chart compares how the RSI behaves when using different period settings, 7, 14, and 21. At the top, you see the price movement. Below it, the RSI is displayed in 3 separate lines. The red line represents the fast 7-period RSI. It reacts very quickly to price changes, making it highly sensitive. This means it gives frequent signals, especially for short-term momentum. The chart highlights that the fast RSI often reaches the overbought zone above 70 and the oversold zone below 30 sooner than the other settings. The blue line shows the standard 14-period RSI. This is the most commonly used version and provides balance signals. It is not too fast and not too slow, making it useful for identifying general trends. The chart marks examples where the standard RSI gives a clearer and more stable signal compared to the fast RSI. The green line represents the slow 21-period RSI. It moves much more smoothly because it averages more data. This makes it less sensitive, but more reliable for long-term trend analysis. It rarely reaches extreme levels, which helps filter out noise from rapid price fluctuations. Overall, the chart shows that shorter RSI periods generate quicker but more frequent signals, while longer periods provide smoother, steadier signals. Traders choose this setting based on whether they want fast, medium, or long-term trend information.
This chart illustrates the concept of RSI divergence, which can signal a potential trend reversal. On the left side, the price action is shown forming higher highs. This means each new peak is higher than the previous one, suggesting that the market is still pushing upward. However, on the right side, the RSI indicator shows the opposite pattern. Instead of making higher highs, it forms lower highs. This mismatch between price action and RSI is called divergence. When the price keeps rising but the RSI fails to follow, it suggests that momentum is weakening. The chart highlights two sets of highs, higher high 1 and higher high 2 in the price, matched with lower high 1 and lower high 2 in the RSI. This divergence often warns that the uptrend may be losing strength and a potential trend reversal could occur. Traders use this signal to prepare for possible changes in market direction.
This chart explains two major types of divergence seen in technical analysis: regular divergence and hidden divergence. Regular divergence typically signals a potential trend reversal, while hidden divergence usually signals a continuation of the current trend. In the top left section, we have regular bullish divergence. Here, the price makes a lower low, but the indicator, such as the RSI, makes a higher low. This mismatch suggests that even though the price dropped further, the momentum did not weaken as much. As a result, it can warn of a possible reversal to the upside. On the top right, we see regular bearish divergence. In this case, the price forms a higher high, but the indicator forms a lower high. This shows that while the price pushed to a new peak, the underlying momentum did not support that move. This often signals a potential reversal downward. In the lower half of the chart, we move to hidden divergence. Hidden bullish divergence is shown on the bottom left. Here, the price makes a higher low, but the indicator makes a lower low. This suggests that the market is still strong and likely to continue its upward trend. Finally, on the bottom right, hidden bearish divergence occurs when the price forms a lower high, but the indicator forms a higher high. This indicates persistent weakness behind the scenes and suggests that the downtrend is likely to continue. Overall, regular divergence helps identify possible trend reversals, while hidden divergence helps confirm trend continuation.
This chart shows how a bullish RSI divergence setup works and how traders can use it to anticipate a potential trend reversal. In the price section at the top, you can see that the market is forming lower lows during a downtrend. Each new swing low is lower than the previous one, which normally indicates ongoing bearish pressure. However, when you look at the RSI indicator below, the opposite pattern appears. The RSI is forming higher lows, meaning that momentum is actually strengthening even though the price is still falling. This mismatch between price and RSI is called bullish divergence. As the divergence develops, traders wait for confirmation. Confirmation can come in different forms, such as price breaking above a recent swing high or the RSI crossing above a key level.
Once confirmation appears, the chart marks an entry point where a trader could enter a long position. The stop-loss level is placed just below the most recent swing low to protect against further downside. The target zone is highlighted at the top of the chart, showing where the trade aims to take profit as the trend shifts upward. Overall, this setup illustrates a classic bullish reversal pattern. Price makes lower lows, RSI makes higher lows, momentum strengthens, and the market often turns upward afterward. This chart shows how a bearish RSI divergence can act as a sell signal. In the price section at the top, the market is moving upward and forming a series of higher highs. Each new peak is higher than the last, which usually suggests a strong uptrend. However, when you look at the RSI indicator below, the opposite is happening. Instead of making higher highs, the RSI is making lower highs. This means that while the price continues rising, the momentum behind the move is weakening. This mismatch between price and RSI is called bearish divergence. The shaded entry zone on the chart marks the area where traders look for a sell opportunity after spotting the divergence. Once the price shows signs of slowing down or breaking below support, traders can enter a short position. A stop loss is placed above the most recent swing high to protect against sudden upward moves. As the trend reverses, the price begins to fall, eventually reaching the target zone where the trade can be closed for profit. Overall, bearish RSI divergence warns that an uptrend might be losing strength and could soon reverse downward. Traders use this signal to prepare for a potential sell entry. This chart demonstrates a simple step-by-step method for identifying RSI divergence. The first step is to look at the price action and mark the major highs. In the image, these highs are highlighted with circles on the price chart. The second step is to check the RSI indicator below and mark its highs and lows. These RSI peaks are also circled so you can compare them with the price highs. The third step is to compare the two sets of highs. If the price is making higher highs, it suggests that the trend is still moving upward. However, in the final step, you look for a mismatch between the price highs and the RSI highs. In this example, while the price continues rising and forms a new higher high, the RSI does not follow. Instead, the RSI forms a lower high. This mismatch signals a divergence. When a divergence is detected, it warns that momentum is weakening, even though the price is still climbing. This often leads to a potential reversal or a slowdown in the trend. By following these 4 steps, identify price highs, identify RSI highs, compare them, and look for differences, traders can quickly spot divergence and prepare for possible changes in market direction. This chart shows a simple beginner strategy that combines RSI divergence with a trendline break to identify a bearish reversal. First, the price is in a clear uptrend, so a support trendline is drawn underneath the rising lows. This is step 1. Identify the uptrend and draw the support line that connects the major lows. As the trend continues higher, the price makes a new higher high. However, at the same time, the RSI indicator below forms a lower high instead of rising. This is step 2, spotting bearish RSI divergence. The price is still climbing, but the RSI is losing momentum, which becomes an early warning sign that the trend may weaken. Next comes step 3. A confirmed sell signal appears when the price finally breaks below the trendline support while the RSI continues to show the divergence. This combination of signals increases the reliability of the entry. The chart marks this moment as the clear sell entry zone. After the break, the price continues downward following the expected bearish reversal. The RSI divergence highlights hidden weakness, and the trendline break provides the trigger for taking the trade. By using both signals together, traders gain a higher probability opportunity to enter a reversal early and exit before the downtrend loses momentum.